Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Hedge Fund Investing, a complete guide for savvy investors. Hedge funds pool money from investors to pursue aggressive strategies for high returns. Unlike mutual funds, they often target wealthy individuals and institutions willing to take on more risk for higher rewards. Their flexibility allows them to invest in everything from stocks to complex derivatives. In this guide, we'll break down how hedge funds work, their pros and cons, and whether they belong in your portfolio. You'll learn what makes them different and how to evaluate them like an experienced investor. If you're considering hedge funds, understanding their risks and potential rewards is key. For those looking to diversify beyond traditional assets, hedge funds offer unique opportunities. But they aren't for everyone. Let's explore how they operate, who should invest, and what to watch out for. What are hedge funds? Hedge funds are private investment funds that pool money from accredited investors, like wealthy individuals or institutions, to chase high returns. Unlike mutual funds or ETFs, they have fewer rules, allowing managers to use aggressive strategies most traditional funds can't touch. They thrive on flexibility, investing in stocks, bonds, currencies, real estate, or even obscure derivatives. And because they're less regulated, they often charge hefty fees, 2% management plus 20% of profits, for their expertise. Key characteristics of hedge funds. Hedge funds stand out in the investment world for several reasons. Limited investor access. Most hedge funds require high minimum investments, often $1 million or more, and only accept accredited investors who meet income/net worth thresholds. Aggressive strategies. They use leverage, borrowed money, to amplify gains and risks. They might also short sell stocks or bet on macroeconomic trends. Wide investment scope. From startups to bankruptcies, hedge funds can bet on virtually anything, including unconventional assets like art or intellectual property. High fees. The 2 and 20 fee structure, 2% annual management fee plus 20% of profits, incentivizes managers to chase big wins. Types of hedge funds. Not all hedge funds follow the same playbook. Here are the most common types and how they operate. Long or short equity funds. These managers buy undervalued stocks, long, while betting against overvalued ones, short. They aim to profit whether markets rise or fall, but face risk if both bets go wrong. Global macro funds. These funds bet on large-scale economic shifts, like interest rate changes or currency moves. They might trade commodities, bonds, or currencies based on global trends. Event-driven funds. These focus on corporate events, mergers, restructurings, or bankruptcies to find mispriced opportunities. For example, buying a company's debt before a restructuring, hoping for a payout. Each type carries its own risk level. Long, short funds may be steadier, while macro funds can swing wildly based on global events. How hedge funds generate returns. Hedge funds chase returns by deploying strategies most investors never touch. Unlike traditional funds that simply buy and hold stocks, hedge funds take calculated risks, using leverage, derivatives, and unconventional bets to outperform markets. Their goal: generate alpha or returns above the benchmark, no matter which direction the market moves. But how? It comes down to strategy, discipline, and a keen eye for mispriced opportunities. Some funds bet on mergers, others trade volatility, and a few even profit from corporate distress. The methods vary, but the aim is the same: beat the market with precision. Common hedge fund strategies. Hedge funds thrive on specialized tactics tailored to market conditions. Here's how some of the top strategies work. Market neutral. These funds balance long and short positions to cancel out market risk. For example, they might buy undervalued tech stocks while shorting overvalued ones in the same sector. The result: gains from stock picks, not market swings. Merger arbitrage. When Company A announces plans to buy Company B, the target stock often rises, but not to the full offer price. Arbitrageurs buy the target, betting the deal closes. If it does, they pocket the difference. If it fails, they lose. Distressed securities. These funds scoop up bonds or stocks of struggling companies, betting on a turnaround. Think of airlines during a travel slump. If they recover, the payoff is huge. If not, losses pile up fast. Each strategy shines in specific conditions. Merger arbitrage works best in booming deal markets, while distressed investing thrives during recessions. Performance metrics for hedge funds. Measuring hedge fund success isn't as simple as tracking returns. Because they take unconventional risks, standard benchmarks like the S&P 500 often don't apply. Instead, investors rely on deeper metrics. Sharpe ratio measures risk-adjusted returns. A ratio above 1 means the fund rewards investors for the risks taken. Below 1, the compensation isn't worth the volatility. Alpha reveals whether a fund beat its benchmark after adjusting for risk. Positive alpha means the manager added real value. Negative alpha suggests they underperformed. Beta shows how closely a fund's returns follow the market. A beta of 1 moves with the market. 0 means no correlation. Many hedge funds aim for low beta to stand apart. Benchmarking remains tricky, though. Hedge funds often compare themselves to custom peer groups, not broad indexes, and their illiquid holdings can make returns appear smoother than they really are. Investors must dig deeper than surface numbers. The best funds balance bold strategies with rigorous risk controls. After all, chasing alpha means nothing if losses wipe out gains. Risks and challenges of hedge fund investing. Hedge funds promise high returns, but they come with risks that can catch even experienced investors off guard. From opaque fee structures to unpredictable market moves, understanding these challenges helps you decide if hedge funds fit your risk tolerance. Regulatory and transparency concerns. Hedge funds operate in a gray area of financial regulation. Many avoid SEC registration by limiting investor numbers or only accepting accredited investors. This lighter oversight gives managers flexibility but leaves investors with fewer protections. Transparency is another issue. Unlike mutual funds, hedge funds aren't required to disclose holdings regularly. You might not know where your money is invested until after a big loss. Some funds share details voluntarily, but others guard strategies closely, calling them proprietary. Key transparency gaps include limited reporting. Monthly or quarterly updates are common, but some funds delay bad news. Complex strategies. Derivatives and leverage can make risks hard to measure. Side letters. Some investors get special terms, like fee discounts, creating unequal treatment. Without strict rules, investors rely heavily on trust, making due diligence critical. Stay tuned for Part 2, where we'll dive deeper into the risks, fees, and how you can start investing in hedge funds. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.